I think cautiously optimistic, Steve, is the right place to be. We've had a very strong summer. I mean, compared to pre-COVID rather than last year. Pre-COVID traffic in the peak summer quarter was up 11% and yields were up 15%, which is very unusual, as you know, in our industry. We look set for a strong winter, but you know, I'm conscious last year we had Omicron at the end of November, which crushed Christmas, and the Ukraine invasion crushed Easter. So it's very fragile. We've done very well. We're the only big airline in Europe that's operating at high above pre-COVID capacity. We've restored profitability to COVID levels, which enables us in December to restore the payroll or the agreed payroll cuts for about 90% of the pilots and the cabin crew, which we're very proud of. But passenger spend is strong. We've been a little bit surprised. I mean, we thought it would dip into September, October. There's so much negativity about customer spend, price inflation, which is real. But this is unusual. I mean, this is certainly in my lifetime the first time we've gone into a recession with almost full employment across Europe. People are spending, they're certainly spending on travel, and I think one of the learnings that's going to come out of COVID is they were locked up for 2 years. Travel is going to be one of the things they're going to keep doing.
Yeah, I couldn't agree more on that, on the demand front. But on the supply front, something that has always resonated that you told me years ago, and you've mentioned it a few times in various cycles, that at the bottom, this industry, everyone's gloomy, but at the top, there are so many airlines in it, and the barriers to entry are low, and you can't maintain that fair discipline because so many people are trying to undercut you. Is it different this time? Because finally, money is being priced differently.
I think there's I would say there's a risk opportunity that is different this time because so much capacity was taken out during COVID. You've seen airlines, Thomas Cook, Flybe gone bust. Alitalia have taken out 50% capacity. It's not coming back. TAP have taken out about 40% of their capacity. EasyJet, Wizz and others are still not operating back at their pre-COVID volume. So this feels slightly different. And then I think the real overhang here for the next 2 or 3 years is going to be much higher financing costs. You know, the days of cheap money are over. You know, this feels to me like one of those Warren Buffett moments when the tide goes out, you see who's wearing swimming trunks and who's naked. And I think we're going to see that in our industry in the next 2 or 3 years. Mm-hmm. Already the legacies are talking about more M&A, TAP is a target, Alitalia is a target. I think we're going to see in the next 4 or 5 years, but I've been saying it for 10 years now, the final consolidation when Europe moves towards 4 large airlines, 3 big connecting carriers and 1 large low-cost carrier.
Michael, in that context, it's hard to see how demand holds up across the board because we've got lists that have been drawn up in a lot of companies, but what comes next if demand starts to fall in their own specific industries? You know, it's been a very strong travel period. Surely the demand side must tighten at some point, even if we're not seeing it here.
I mean, that's absolutely correct. I mean, and we've been waiting for that demand to tighten up, but we haven't seen it yet. I mean, the October midterms are very strong. Christmas looks very strong, but there's a fragility there. If there was an adverse development in COVID or an adverse development in Ukraine, Christmas could still fall over. But if it doesn't, it looks very strong. And I think what's unusual this time around is that people are still employed. There's still a lot of job vacancies. People are still spending, but they're spending on, I think, food and travel and energy.
Do you want to talk about distributions to shareholders? Because it sounds as though preservation of cash might be king at some point.
Sure.
So having a bank that you can tap into. You've mentioned that it's not going to be a priority for next year. So when can shareholders expect this to be a priority?
I think our shareholders are, we've rebuilt cash flow. We have a very strong balance sheet. We're sitting on about $4.5 billion of cash at the moment. But in the next 12 months, we have $1.5 billion of bonds that we're going to repay. We're not going to refinance them. We're going to pay them down. And then we've about $2 billion in gross capex. We'll take delivery of about another 51 aircraft from Boeing if Boeing can deliver them on time. So we're at peak capex at the moment, but I think our focus will be, rather than distributions to shareholders, will be pay down debt. We closed the year in March at $1.5 billion of net debt. At the end of September, that's down to $500 million of net debt. So we're determined to go. We're going back to zero net debt in April of next year. And thereafter, I think once we've paid down the bonds in the next 12 months, then we'll look at shareholder distributions. And we couldn't have looked at it until we'd fully restored the pay cuts to the crews. That's been done in the December payroll.